If you own a holiday let here in the UK, I want you to listen closely. The ground is literally about to shift beneath your feet. We are looking at the biggest tax shakeup for this sector in over 40 years, and it's going to completely rewrite the rulebook.
Mark your calendars, because from April 2025, those special tax advantages that so many of you have built your businesses around, they're being abolished for good. So the big question for every single owner is, are you really truly prepared for what's coming next?
To help you make sense of all this, we have teamed up with the property tax specialists over at My Tax Accountant. Together, we're going to break down exactly what's changing, how it's going to impact your bottom line, and most importantly, the practical steps you can take right now to get ahead of it.
So here's our roadmap for this discussion. We'll start with the huge headline change. Then we'll dig into the specific benefits you're about to lose. After that, we'll tackle the new reality for your income tax and capital gains, give you a concrete action plan, and show you exactly where to find that expert help. Sound good? Let's get started.
Okay, let's start at the very beginning. The heart of this massive change is the complete abolition of what's known as the Furnished Holiday Let, or FHL, tax regime.
So you might be wondering, what exactly makes a rental a furnished holiday let in the eyes of the taxman? Well, it's not just any old holiday rental. To get these tax perks, you had to pass a series of strict tests from HMRC, things like being available to rent for at least 210 days a year and actually being rented for 105 of them. Hitting those targets was the golden key that unlocked a whole suite of very valuable tax breaks.
And this isn't some new thing. As you can see here, this special regime has been around since 1982. For over 40 years, it's treated these properties more like active, trading businesses than just passive investments. The government's goal now, they say, is to level the playing field between short-term lets and long-term residential rentals. Well, after 4 decades, that distinction is being completely erased.
Right, now for the part that really matters. What exactly are you losing? This is where we see the end of what many people considered a golden era for holiday let investment in the UK.
This list really shows the scale of what's being taken away. Let's just run through it. First up, full mortgage interest relief. A massive benefit, especially for higher rate taxpayers, that's gone. Then, the special capital gains tax rates that made selling so profitable are disappearing. Capital allowances for things like furniture and fittings, they're being scrapped too, and even the perks around pensions and splitting income with a partner are being removed. This isn't a tweak, it's a complete overhaul.
So let's move on to the most immediate impact, your income tax bill. For many of you, this is where these changes are going to be felt first and probably the hardest.
This slide shows the stark difference. Before, you could deduct all of your mortgage interest from your income before the tax was even calculated. So if you were a 40% taxpayer, that meant a 40% saving on that interest. Simple. From April 2025, that's being replaced by a flat 20% tax credit. The bottom line, if you're a higher rate or additional rate taxpayer, your tax bill is going up, even if your income and mortgage costs stay exactly the same.
To make this crystal clear, let's use an example. Meet Sarah. She's a pretty typical holiday let owner. She's got a lovely cottage in a popular tourist spot, she's a higher rate taxpayer, and she has a mortgage on the property.
Okay, let's look at the numbers. Under the old rules, Sarah could deduct her full £10,000 of mortgage interest. At her 40% tax rate, that saved her £4,000 in tax. But under the new rules, she only gets that 20% credit, which works out to just $2,000. So the crucial point is this one rule change is going to cost her an extra £2,000 in tax every single year. That is a significant hit to her profits.
Now here's a quick pro tip for you, and this is a big one. We mentioned capital allowances. That's basically tax relief for spending on essential items for your property. Think furniture, fixtures, a new kitchen. Since this relief is being abolished, there is a small window of opportunity. If you have major works planned, getting them done and paid for before that April 2025 deadline could let you make one last, very valuable claim.
So, that covers the income side of things. But what about when you decide to sell your property? Well, the changes to capital gains tax, or CGT, are just as dramatic.
This chart really says it all, doesn't it? Previously, a qualifying holiday let could benefit from something called business asset disposal relief. You can think of it as a huge reward for running a business, allowing you to pay tax at just 10% on your profit when you sold. From April 2025, that's gone. Your property is now treated just like any other residential property, and the CGT rate for higher rate taxpayers jumps all the way up to 24%. Your tax bill on the exact same sale could more than double.
And stay with me because this next point is absolutely critical. To stop a mass sell-off, the government introduced what's called an anti-forestalling rule. What this means is if you exchange contracts to sell on or after March 6, 2024, but the sale only finalizes after April 5, 2025, you are caught by the new higher tax rates. The timing here is everything, and honestly, it's a trap for the unwary.
Okay, we've laid out the challenges, and I know it's a lot to process. But the key here isn't to panic, it's to plan. So let's shift gears and start building your action plan to tackle this head-on.
So with the clock ticking down to that deadline, what are the practical, real-world steps you should be taking right now to prepare your business for this brand new tax landscape?
Here's a clear 3-step plan. First, as we just mentioned, review your capital spending. Can you bring any of those refurbishments forward to claim those final allowances? Second, if selling is even a remote possibility on your radar, you must get advice on your CGT position and those critical dates. Finally, and this is a big one, reevaluate your entire business structure. For some, operating as an individual may no longer be the best option, and exploring a limited company structure might be the way forward.
And that third step, reevaluating your entire business structure, leads us perfectly into our final and perhaps most important section, the absolute necessity of getting expert help.
Look, these changes are not straightforward. The way income tax, capital gains, and different business structures all interact is incredibly complex. The right path for one owner will be the completely wrong one for another. This is absolutely not the time for guesswork.
And this is the crucial takeaway. A generic, one-size-fits-all approach just isn't going to work. You need a tailored strategy based on your specific property, your personal financial situation, and your future goals. A specialist tax expert can analyze your unique position and help you build a robust plan to mitigate the impact of these changes and keep your business on a profitable footing for years to come.
Now, before we wrap up, a quick but very important note. Everything we've discussed today is for general guidance. It's designed to inform you and get you thinking, but it is absolutely not a substitute for professional financial advice tailored to your specific circumstances.
So before you make any big decisions, please speak to an expert. For professional, tailored advice on how these huge changes will affect your business, and for help with any other tax questions you might have, we highly recommend getting in touch with the specialists at My Tax Accountant. Their contact details are right there on the screen. Thanks for joining us.